Welcome to Hedge Fund Tips with Tom Hayes. This is for the week ending August 14th, 2020. This is our 43rd VideoCast and 33rd podcast episode. So as always, we're going to kick it off with our media spots real quick and what we covered. First was CGTN America TV yesterday. We were on and they wanted to discuss the impact of COVID on jobs. And what I was covering was that as of January and February, we were at our lowest unemployment rate since the early 1950s after World War II. And because of having to close down businesses for COVID, it spiked up to 14.7. We've now fallen back to 10.2. And looking at the initial jobless claims this week, yesterday beating expectations, coming in at below 1 million for the first time since the pandemic started, at 963,000 versus 1.1 million estimates. And that's also down from the April peak of 6.86 million. So that was really good news. Continuing claims were less than expected, down to 15.4 million relative to the peak in May of 24.9 million. And the unemployment ratio came down from 14.7% peak to 10.2. Average weekly hours worked actually hit a record a couple reports ago, which was nice to see because during the great financial crisis they plummeted. The other thing that was interesting is of the jobs lost, so the combined was 21.5 in March and April. We've regained 9.25 million in the last 3 months, May, June, July, which is 43% of the jobs lost have already been regained, which is just amazing. And it's testament to the magnitude and speed of the action between the administration. Secretary Mnuchin obviously played a big role, Larry Kudlow, Congress, and the Fed all coming together in record speed, and then global fiscal stimulus and global monetary stimulus as well. So that's exciting to have regained 43%. More work to go. President Trump issued the executive order that we anticipated last Friday. He issued on Saturday, which means it looks like the extended unemployment is going to be, I know there's been, is it 300 and the states pay 100? And then they came back and said that the federal will pay 100%, either from previous funds they gave them or straight away. But they have more than enough in the FEMA emergency fund. I think this package is going to be like 44 billion or something, and they've got more than that. So they can do it through the executive order, which means the fiscal cliff that everyone's been worried about is no longer really a factor, albeit it's not 600 extra per week. So they used to get 400 from the state and 600 from the Fed. It'll be 400 and 400, which is $3,200 a month, which for many people that were receiving it throughout the country, maybe not on the coast in particular, but throughout the country, that's in excess of what they were earning before. Certainly at the $600 level, now at the 400, it probably incentivizes a lot more people to pick up jobs, which we saw in the JOLTS report. We're going to cover the economic data later in this podcast videocast. Job openings continue to rise, so there are plenty of jobs out there, and it seems like the best of both worlds was done. On the one hand, we didn't hit a fiscal cliff because people's state unemployment is still going to be doubled. It's not going to be 150%. It's not going to go from 400 to 1,000. It's going to go from 400 to 800. That's coming out by executive order immediately. So that's a good thing. No fiscal cliff on that front. But on the flip side, people realize, oh my gosh, this almost went to zero. If a job comes, I got to take it, and I got to beat the crowd back to work because, if this lasts 4 weeks or 6 weeks until that FEMA emergency fund is drained, then I don't want to be the last person looking for a job. So I think that was reflected in the continuing claims coming down, the unemployment rate coming going in the right direction. I think people are now sensing this. So those who can get a job and there's jobs available, rather than being incentivized to stay home, they're now going to go take those jobs, and that's going to help the unemployment rate and get things going even faster. So it's the best of both worlds on the extended unemployment. Do we still want to see stimulus checks to those most in need? $1,200 an adult, $500 per child under a certain income barrier like the first one. Yeah, that would be nice. We'll see if that happens in coming weeks. My sense is that if it continues to require money to fund mail-in voting, no deal will be done. If they can negotiate on that, I think that the administration is going to be willing to give more money to the states than they're initially offering, which would hopefully get the Democrats to move in the direction if the administration's willing to move in the direction. But if it comes down to mail-in voting, then there's going to be no deal. And candidly, the amount of money that's been authorized and put into stimulus and unused, we've had close to $10 trillion between stimulus, liquidity, and aid authorized. We've probably used about a third, balance sheet expansion, $3 trillion, and then you have the CARES Act. But a lot of the facilities for the Fed, Main Street lending, et cetera, have not been fully used. So we still have huge capacity. Money supply growth has increased by 25% in the last 3 months. Usually about a quarter of that goes into nominal growth. So you could expect 6.5% of GDP growth in 2021, if history is any prologue, when you have money supply growth of that magnitude, which will be the fastest rate in a long time. So, it's like a frog in a pot. No one's hot enough where they have to blink to do a deal like people did in March and April when we were in the middle of a catastrophe. I think it's the best for the country, for people who are still suffering, if they can get this done. Unfortunately, the president can't get the stimulus checks done by administrative action. Otherwise, he would, to help the neediest people. So hopefully they'll come together and do a carve out at least for that, and leave the other stuff aside until after the election. But we'll see. So we covered that, and they also wanted to know. My interviewer's name was Sunny on CGTN America. She said, "Well, why are things going so well?" There are 5 key reasons. Earnings and estimates continue to beat. As we know now, with 90% of the earnings in, about 83% beat rate. Estimates are going up for the first time since Q1 of 2018, so consensus is now well above $165 of earnings for the S&P 500. Economic data, which we'll cover at the end, the Citibank Economic Surprise Index is still at record highs, meaning the amount of data that is beating consensus estimates on a daily and weekly basis is still at record highs. The stimulus aid and liquidity we just covered. Money supply growth. We're getting vaccine news, good vaccine news, and therapeutic news basically on a daily basis now. Hundreds of shots on goal. We're getting closer and closer, so that's always good news. And the new cases are finally slowly and stubbornly declining. Certainly the Sun Belt's coming off the boil now. The epicenter, New York, New Jersey, and Connecticut's doing phenomenally well. And then we're getting hot spots as it migrates into the Midwest. But on balance, they're coming down, which is a good thing. So that was CGTN. I want to thank Zaina Al-Saeed for having me on. And moving on to yesterday, the article we're going to cover today is called the Gordon Gekko Gridlock is Good Stock Market, which I put out yesterday morning. I wrote Wednesday night. And it was actually picked up in pretty much in whole by Sean Langolis at MarketWatch. MarketWatch, Wall Street Journal, Dow Jones, and Barron's are all one group. And you can go to MarketWatch. You can either just click on the website under Featured On, it's there, or go to MarketWatch and click on Sean Langolis, or search. He titled it, "Here's How Savers, Both Republicans and Democrats, Should Vote to Avoid a Huge Hit to Their Nest Eggs." So he's a better title writer headline writer than I am. That's why he's a pro. But thank you to Sean for picking that up, and you can see it at MarketWatch with comments and all. There are quite a few, and you could tell that probably 50% of the comments, the people didn't read the full article. They just read the first sentence and drew conclusions. Good to know. But so that was a real honor and very exciting. And then on Monday, I want to thank Medicine and Amber Warwick for including me there in their article on Reuters. They were just asking about the market, and the quote that they took from a 5-minute conversation was, "I think the path is paved now between the vaccine news, executive orders, economic data, and earnings, and that money on balance in coming weeks and months will continue to move into cyclicals. Particularly for many of the people who missed the rally, cyclicals is the only place where you can still find value." So that theme persists, and it actually played out this week. We're going to cover that right now. So for the article of the week, and by the way, for those of you tuning in, it's Friday night. If you're tuning in to hear about the elephant in the room, what Warren Buffett did in his filing tonight after the close, we're going to spend a lot of time on banks, so hang tight. But let's or fast forward, but hang tight. So the article we did is called "The Gordon Gekko Gridlock is Good Stock Market and Sentiment Results." For those of you who have been around for a while, you remember the 1987 classic film. Michael Douglas played this character, called a corporate raider called Gordon Gekko. And he gives this quintessential speech in the Roosevelt Hotel on 45th and Madison. That greed is good as it related to taking over a bloated company with huge amounts of middle management, cutting costs, et cetera, corporate raider type theme from the milk and junk bond era, when anyone could raise a ton of money, kind of like the SPAC era right now, and buy companies. So we crossed out greed, we put in gridlock, and that is because we're now some 80 days out from the election. And it's really important that everyone listening to this, regardless of whether you're a Democrat, whether you're a Republican, I'm sure, my bet is there are many independents listening to this. I think I probably attract mostly centrists. But leaving that aside, we need to understand the implications of the election results as they relate to the stock market. This is a stock market podcast videocast. This is not a political podcast videocast. This is not a social. This is not a moral or ethical or religious podcast. It has nothing to do with any of that. It has to do with whether the stock market goes up or down. So we're framing the subject from that point of view, and then you have to add your own color based on your hierarchy of priorities, etc. But for the purpose of this podcast videocast, we're going to deal with the impact on the stock market. So the punchline is, just to cut to the chase for those of you who like the Cliff's Notes version, for the stock market, it really doesn't matter which party wins, so long as no one wins complete power. Okay, so provided there's not a sweep of the executive, Senate, and House, I think generally any other outcome is going to be bullish for the stock market. And that particularly has to do with what has already been set in motion with the stimulus aid, liquidity, money supply growth, recovery coming out of recession, etc. So that's that. Now, you can say sentiment has a lot to do with it, and people are going to feel one way if one administration is elected, and another way if another administration is elected, and that's fine, and that's the intangible that really can't be measured. We're not going to get into that. But I did find a table from Bank of America from the 2018 midterm elections. And what they basically did was they took the stock market returns from 1928 to 2018, and they showed what were the returns like if it was a Republican sweep, if it was a Democratic sweep, if it was a Democratic split, a Republican split, etc., and what the returns were like during those periods. Now, the problem with this table is that it's skewed because it started in 1928 versus 1934. If you take the Great Depression, which is the blackest of black swans, out of it, basically, if you had a Democratic sweep, your average return was 14.1% a year. If you had a Republican sweep, your average was 14.0%. If you so that might have skewed up. So more or less, it's basically the same if you have a Democratic sweep or if you have a Republican sweep, about 14% a year during those periods. The splits are bullish, but any combination of splits are perfectly fine, Democrat or Republican Senate, so long as no one has complete power. Now, the problem is this time is actually different. And I never say that, but I'm going to explain mathematically why it's different. So while it doesn't matter if you have a sweep historically, it does matter this time because there is a major policy prescription on the table related to corporate tax rates, which affects earnings for the S&P 500. And when you affect the equation, which is basically earnings times some multiple, the multiple being affected by expected growth and the discount rate or interest rates, how you discount net present value, then once you affect one side of that equation, oftentimes it affects the other, but it certainly affects what comes after the equal sign. And to, ideologically, Democrats think they're better because they tax more and they tax the rich. Republicans think they're better because they don't tax. But fundamentally, if you look over time, they're basically the same, because what the Republicans do is they borrow and spend a lot versus the Democrats who tax and spend a lot. But fundamentally, they both do the same thing, which is they spend. And I'm not making a commentary on whether spending is good or bad. I'm kind of like Friedmanite with a Keynesian middle name kind of thing. So I'm like a blended drink, so to speak. It is what it is, but it's just they get to the same end point in different ways. One is taxing, one is borrowing, but spending is the end result. The private equity folks listening in or reading the article know all too well that borrow and spend always looks better in the short term because you can show earnings power today that you'd not be able to if you had to reinvest all your profits due to lack of borrowing. So borrow and grow always looks better than tax and slow in the short term. Yes, I came up with those two terms, borrow and grow versus tax and slow. Anyway, I didn't file for a trademark, so feel free to run with it. Leaving that aside, so basically going into November, and I'm less concerned about what they do to marginal tax rates for personal income tax. That'll certainly affect us individually, but with regard to the stock market, what they do to the corporate tax has an explicit impact on earnings. So the Republicans say they want to cut capital gains even more. They're already low at 20%. They want to cut income tax for the middle class. And the thesis is that the growth that you'll get from that will cover, the growth in the short term will cover the borrowing in the long term if you spur economic growth in the short term. It did work in the 80s and it did work in the 50s. So there is merit to that argument. If you recall, the debt to GDP ratio in World War II, late 1940s, exceeded 120%. It was down to mid 60% by 1953, and growth took off. It was an 18-year run until 1968. So that thesis played out. Now, the Democratic ticket is running on three things. You can agree with them or disagree with them. It doesn't matter. But here's what they're running on. One is they want to increase the corporate tax rate from 21% to 28%, and possibly 35%. So that's one. Two, they want to tax long-term capital gains and qualified dividends at the ordinary tax rate of 39.6% versus 20%. That's going to, if there's a Democratic sweep. Remember, you need all three. You need the executive, the Senate, and the House to pass this stuff. So unless they get a sweep, this is not going to happen. If they do get a sweep, you're going to see a big sell-off in stocks because people are going to try to lock in the 20% long-term capital gains before the new administration kicks in January. So you'll see a crash versus waiting for the tax to go up to 40%. And the new Senator Kamala Harris, VP pick, has proposed a financial transactions tax. So it would be 20 basis points of all your stock trades. And bond trades would be, so basically on a $100,000 trade, you're looking at $200. On a $1 million trade, you're looking at $2,000 commission. That's a big change. Bond trades at 10 basis points, and derivative transactions at 0.002%. So let's get into why this matters. So to get the price of the stock market, and a lot of you listening know this, but there are four factors determine the value of the stock market. Number one is earnings. Number two is the PE multiple that's applied to earnings. How many years of earnings are you willing to pay for today? That is a function of two things. One is the expected growth rate. If you think growth is going to be faster, you're willing to pay more for those future earnings. And if you think it's slower, you're going to give a lower multiple to pay less. And then fourth is interest rates, or the discount rate, the price at which you discount future cash flows back to present value. The higher that is, the lower the value of the stock market. The lower it is, the more you can pay up. So, but the most important of those four, earnings, multiple, expected growth, and discount rate, is earnings. So David Kostin at Goldman Sachs put out a note recently that said, in the event of a Democratic sweep, we estimate that the Biden tax plan would reduce our S&P 500 earnings estimate for 2021 by $20 per share. He has it from 170 to 150. So his 2021 earnings are slightly above consensus, which is about 166 for 2021. He says you knock it down $20. Now, I wrote this on Wednesday. The S&P closed at 3380. So if you use Goldman Sachs estimates, which are slightly higher, that means the stock market was trading at 19.88 times 2021 earnings. 2021 earnings defined by David Kostin is 170. So 3380 divided by 170 is 19.88 times. That's the multiple we talked about on earnings. So what is the multiple you're willing to pay on 1 year's of earnings? As of Wednesday, forward earnings was 19.88 times. Now, this is slightly above the 5-year average, which is 17 times earnings, and is well above the 10-year average of 15.3 times earnings. It's justified only on the basis of interest rates staying low. 10-year treasuries still below 1%. It went up from 67 to I think 77 maybe 80 basis points. I didn't look at it today. And growth expectations staying high. Now, so two things facilitate that. One is when more money is going back to business to be reinvested in the business versus going to government where money goes to die, more or less. Okay, there are exceptions. Obviously, we need interstate highways. We need programs to help those most in need. We need a safety net. We can debate all that later. But money is more productively used in the private sector because it's just like you spend your own money better than anyone else spends it for you. It's the exact same thing. And deregulation has been of paramount importance the last 4 years. So that's why growth expectations high, interest rates are low, high multiple is justified. So that's that. Now, what's different this time, when historically Democrats have run on tax the rich and take from those who don't need it and give to those who do, and that's a reasonable point of view. The difference here is now their core platform is raising the corporate tax rate, because historically we have had a high tax rate relative to global competitors. So they couldn't say, let's raise the corporate tax rate from 35% to 45%. That would make no sense. All the companies would leave. So they never ran on that. Now that's the platform, and to go from 21 to 28 and lose $20 of earnings power, here is the basic math that we're looking at. So if you look at what was the 10-year PE multiple, the 10-year average PE multiple during a period when corporate taxes were high, i.e. expected growth was lower, was 15.3 times. The last 10 years average PE multiple, which was skewed during the period during which the corporate tax rate was high, it was 15.3 times. So if you take Costin's $20 hit to earnings on the corporate tax rate, if you have a Democratic sweep, you're looking at earnings would go from 170 to 150. 150 of 2021 earnings by the 10-year average multiple with a lower growth environment, 15.3 times, gives you 150 times 15.3 gives you 2295 on the S&P 500, which is a 32.1% crash from Wednesday's closing prices. If you translate that into the Dow, which generally trade more or less around the same percentages, that would take the Dow from about 28,000 down to about 19,000. And this is not an idealistic point of view. This is just the math. You take earnings down $20, and you can't increase the corporate tax rate by 30 some odd percent from 21 to 28, and not, once you increase the tax rate, you're going to lower the multiple and expected growth. So that's what would effectively, round numbers, people who haven't done the math have said, you'd lose 20%. I think it's closer to 30% because the right multiple, you wouldn't continue to get a high multiple in a low growth environment and a high regulation environment. You'd get an average multiple, 15.3 times 150, and that's where it gets you. So what does that mean in real terms? The average retirement account is $2 million. You would look at a drop to $1.357 million. For someone who's 30 years old, losing $600-something thousand is not a big deal. They have time to earn it back, $642,000. For someone in their 50s to 70s, they may never recover. So it does have real life implications. And it's not a commentary in any way on social policy or style. For some people, they're going to say, I'm willing to lose $642,000 of my retirement account because I'm in such high disagreement with the social and political climate, and I want the world to reflect my worldview for my kids and their kids, and $642,000 of my $2 million or $6.4 million of my $20 million retirement is a small price to pay to put in the ideology and the political policies that I think are going to be better for the world and better for the country. If that's how you feel, that's fine, as long as you understand what the price is. So we can't have our cake and eat it too in this environment as it relates to the stock market. Now, leaving that aside, there are many people, once they have the information and they understand the math, not opinion, but the math of it, will say, I'm willing to write that check. $642,000 of $2 million, for the change that this person feels that we need, then you should go ahead and do that. Now, for those who are more pragmatic or can't afford to make that luxurious donation, then you have to look at the trade-offs, and you might say, well, I just need a change at the executive branch, and if that's the case, then I would hedge out personally if I cared about the value of my retirement by either not voting for House and Senate or voting the other party as a check and balance. And conversely, if you vote Republican for the executive, it's highly likely that right now it looks like the Democrats have a pretty solid lock on the House, so you pretty much don't have to do anything. The Senate is up for grabs, so effectively, if you voted Republican down the ticket, you'd probably wind up, if you're with Republican executive, Republican Senate, and Democratic House. If you vote Democrat down the ticket, you're likely to get Democrat executive Republican Senate, Democratic House. But if you vote for the Senate and the Senate's lost and you get the Democratic Senate, that's when you get the corporate tax change, and that's when you get this 32% potential drop. Look, no one knows for certain exactly what's going to happen, but we do know the math of taking earnings down $20 and taking the multiple down, what the impact is. So that is the impact on the stock market. So what I basically said was checks and balances is the best. Whether you get a Republican or Democratic executive branch, you want to make sure either the Senate or the House is the opposite party, no matter what. And all of those scenarios, other than a sweep, are bullish. If you get a sweep, which it doesn't look like you'll get a Republican sweep, if you possibly get a Democratic sweep, that's where you're going to get this negative stock market outcome. If you get gridlock of any magnitude, then it's bullish. We continue to go up. So if you're a Democrat, you'll be happy that you can have a Democratic executive branch and still be bullish. If you're Republican, you'll be happy that you could lose, have a Republican executive and lose the Senate and still be bullish. So there's something in here for everybody is what I'm trying to say, except the one scenario which would really be problematic. So from a stock market standpoint only, not making political commentary, not making social commentary. If you go on the Market Watch article, you'll see no one read the article. They just made their political commentary and opinion before they looked at the math, except the other 50% of people who actually read it and got it. And both on the Democratic and Republican side, I was pleased to see that as well. But, I did a long thing of a few months back about the cost of caution, when, you can shut down forever, but you have to understand how much it costs each day. And at that point, both in lives and in money. And I think at that point, it was like, I'll have to look back, but it was basically like, I don't know, some multi-tens of billions of dollars a day of economic growth loss. So, that was the cost of caution. And it's the same thing of a sweep. It's like, for some people, that's idealistically the best case scenario. And now when you attach, for the average person, a $642,000 price to it, they may think twice. Similarly, with a Republican sweep, historically, both Republican and Democratic sweeps are fine. It does about 14%. But when it affects one of those four pillars of the formula, earnings, or the multiple discount rate and expected growth rate, that's material. So I wanted to get that message out. Now, something to keep in mind with the current polls that we should all be aware of. No one, and absolutely no one, first and foremost me, knows what's going to happen in November. And last week's VideoCast podcast, I went into Trump's odds of winning. Did not look good. Okay, so he was at like 38% relative to Biden at 58%, and that didn't look good. Senate control. So I'll just take current numbers. Right now he's at 39.5%, so he's picked up a little bit since the Kamala announcement, versus Biden at 57.3%. It still looks like, for an objective, if an alien dropped into my lap and looked at this webpage, you'd say Biden's going to win. Same with the Senate. It's right now at 40%, Republican, 59%, Democrat. So that doesn't look good. So basically what this is saying is sweep, which means you could have that 30% re-rating of discount of the stock market, which at the earliest would be rectified in the midterm elections once people realize what they did to their retirements. So that was really bad news. And I asked on the VideoCast, from a stock market standpoint, okay, that was bad news. That's what this podcast is about. Everyone's all fired up 82 days into the election. If they think you're like selling a political idea, they get really upset. I'm just doing a stock market podcast. So I said, if anyone has the data from 2016, like this looks really bad. What did it look like in 2016? And I actually found it over the weekend. No one sent it to me. Thanks for your help. No, kidding. But basically, on August 13th, which was yesterday, of 2016, Trump's chances to win the presidency were 19.4% versus Hillary Clinton at 76.3%. So this is that exact point in the cycle. And by the way, with the October bust surprise with Billy Bush, it actually fell down to like 15%, which was weeks before the election. But for August 13th, 4 years ago, he was at 19.4, Clinton was at 76.3. And that's why I say no one knows what the hell is going to happen in November at all. Right now, he's got twice the chance of winning in November at this time than he did in 2016. He's at, he is at, as of today, 39.5 versus 19.4. And Biden is at, the Democratic tick's at 57.3 versus Hillary was at 76.3 in mid-August. So we don't know what's going to happen. They're all different types of variables. Jeffrey Gundlach was out. Julia LaRoche did an article for Yahoo Finance, and he was out saying he predicted that Trump was going to win last time, and he's predicting the same thing this time. He might be right, but one is entirely too small of a sample for me to say he knows. He's the guy who knows. All we can do is go by historical data, and the current data, you look at it objectively, you say, doesn't look good. If you look at it relative to historical data, it looks great. But again, what we're hoping for, where everyone can actually win, is gridlock. So if you're a Democrat, you want one of those things to be Republican. If you're a Republican, you want one of those things to be Democrat. If the stock market and your retirement value is one of your higher priorities. If it's not, and you're willing to take the loss in order to have the change that you think is important, then by all means, just know what it costs and then move forward with your decision. Don't make it in the absence of the math. Like when we talked about cost of caution, it's okay to shut down for 6 months. Just understand the cost and the amount of people. Right now, just which is mind-boggling, and I covered this about 4 weeks ago, less people are dying per day from all causes in the United States than has happened in decades. In other words, we have the least amount of people dying every single day in the United States than we have had in decades. Historic lows. Okay? Now, why is that? Well, it's because a lot of people are at home and they're not driving cars and they're not crossing streets and they're not getting into crashes and they're not falling off their bicycles and they're not going to the emergency room. So everything is about perspective. When you look at these things, everything has trade-offs, and that's what we're trying to lay out. Now, in addition to Gundlach, there's another phenomenon happening that few people are paying attention to. There's a reporter at Fox that started to pay attention to it. There's some articles in the Post that started to pay attention to it. But Kanye West is getting on swing states step by step. Some they're contesting him and he's fighting. He's got a serious thing mobilized. He actually put out hats and t-shirts this week, Kanye 2020 Vision. I think that's a clever slogan. And the reason you don't want to underestimate Kanye, a lot of the coverage, they're trying to shame him for some personal challenges that he's having, that he's overcome many times in the past. He didn't get to where he is without overcoming his health issues. He knows how to overcome that, and I'm sure his family's helping him do that. So don't underestimate, because he basically went from, as Forbes puts, from broke to billions, selling consumer products, namely sneakers and Yeezy wear and all of this stuff in the last few years. Now, you don't go from broke to billions selling consumer products if people don't like you. The whole basis of his brand, he's not saying my Yeezy sneakers have better technology than Nike's and they'll make you run faster. That's not the pitch. The pitch is, I'm Kanye West, buy my sneakers because I'm cool, and the majority of the country believes that in that age believes that that's the case. And I would buy Yeezy, I would buy his sneakers. I think they look cool, and I think he's cool, and I love his music. So so do not underestimate his ability to sell to the younger demographic that could swing things. Now, what I also note that I think Republicans aren't counting on, because people look at this and they worry that he's going to split the vote on the Democratic side, just like Ross Perot split it on the Republican side for Bush in the 90s. But what the Republicans aren't looking at is, if he continues to get on all these ballots, he's going to draw a lot of young voters who would not ordinarily show up to vote. And because he's running under the quote birthday party, because it's not Democratic Party, not Republican, he's calling it the birthday party because he says if he gets elected, it's everyone's birthday, which I think is clever as hell. But there are no Senate or House candidates running under the birthday party. So when these people who ordinarily may not vote show up to vote for Kanye West, they're probably going to vote the whole ticket, and they're probably going to vote Democratic, which means it could be a Pyrrhic victory for the Republicans who think that Kanye West is the new Ross Perot on the flip side, because while they may get the executive from getting the electoral votes, they could wind up losing the Senate, which, if you're a Republican, that may upset you, but from a stock market standpoint, because that's all we're talking about here, that's also bullish. So it could be Republican executive, Republican Senate, Democratic House, that's bullish. Republican executive, Democratic Senate, Democratic House, that's bullish. Democratic executive, Republican Senate, Democratic House, that's bullish. Just not the sweep. That's the one that's going to kill us with the corporate taxes, taking down earnings, taking down the multiple, taking down everyone's stock values. Okay, so we covered that. Keep an eye on Kanye West. That's a serious factor that I think people aren't accounting enough for. That could play out. Finally, we covered jobs, which we covered a lot on CGTN. You can see the trend here. We're not going to spend a lot of time on that. Unemployment's come down, continuing claims down, initial jobless claims below 1 million. This was the record hours per week. You can see this popped up here a few reads ago, and it stayed at elevated levels, whereas the great financial crisis, it dipped all the way down to 33 hours per week. Here it's up at 34.5. And you can see how quickly we're gaining. We had 2 months of huge losses. We've already gained back 43% of those jobs, so that's a good thing. And then Cyclicals update, as you can see, and we spent a lot of time on in recent weeks, as we get closer to a vaccine treatment / herd immunity, this trade's going to become more and more apparent. They started to outperform in a big way early in the week. So we just put the charts here from financials to technical. This is a ratio chart. You can see it's taking off the bottom. Energy to technology is bouncing off the bottom. Defense stocks to technology, again, bouncing off the bottom. And home builders, which have already had a huge move off the bottom, they're also bouncing this week. So that's positive to see. If you get shutdowns in regions, you're going to see tech go back to perform. But as you I think people are really just getting on with their lives, they're going out, they're doing their stuff, they're putting their mask on, and as long as people get numb to those little flare-ups and just continue to go about business, as we're seeing in the economic data, cyclicals are going to outperform, because they always do in the early stages coming out of a recession, and we've just finished the 2 quarters of negative GDP growth. And if you look at Atlanta GDP now, it's expected to be 26.4% GDP growth annualized for Q3. So that's going to be a huge quarter. and that's going to be very, very good for consumer confidence, business confidence, and the whole thing. So this is when you have those huge galloping growth rates when cyclicals start to outperform on a relative basis to growth. Finally, on the article, we saw the bullish percent come up to 30%. That's still nowhere near an extreme level. So people are still skeptical as we're knocking on the door to all-time highs. We came in within a few points. I think it was 5 points on the S&P a couple days ago. Looks like it wants to bust to new highs on the S&P. That would be a nice thing. Obviously, a stimulus package would do that. I'm not holding my breath, although I'm just trying to figure out who has more at stake here, because on the one hand, the Democrats have way more people in their districts that will get the stimulus checks just on demography and income, because you have to be below a certain level, and their population will benefit most from the stimulus checks, and they need more of the money for the states, but they really want the money for mail-in voting, which they're probably not going to get. So especially after Dr. Fauci came out and said there's no reason people can't vote in person like they have, throughout history. So that said, my base case is not that my base case, as I said last week, I don't know that, I certainly don't think we're getting anything comprehensive. Do we get a carve out for the stimulus checks? That would really be a nice thing. I just don't know the answer to that, but that would certainly be something that could push us over to new highs. But we'll take it as it comes. So that has some room to go before we get to frothy euphoric levels. The fear and greed was up to 74. I think it closed at 73 today, maybe. 80 to 100 is the excessive greed, so we're getting close, but not quite there yet, so a little room to run. The National Association of Active Investment Managers is still pinned at high levels, so we got to keep an eye on that. We'll buy any dips for cyclicals and laggard names. And as it pertains to the stock market, gridlock is good. So that was the message of the week. Gridlock is good. And by the way, some people thought I was talking about gridlock this week and how that's bad. I was not referring to the stimulus package. Obviously, I'd like to see a stimulus package go through. But at this point, we have enough with the executive order. That's a good thing. It would be nice to see the stimulus checks. We'll see if that happens, but it's not a catastrophe if they don't come to it. It's better for everyone if they do, so we'll see what happens. Okay, so now we've gotten through the political stock market stuff. Let's get on to the after the close Warren Buffett sells. And all the headlines are Warren dumps banks and buys gold. There are a few things that need to be understood to understand this properly. Number one is Warren Buffett has two guys that run a large portion of his portfolio, and you could usually reverse engineer their footprints. What's Warren? What's his two subordinates, Todd and Ted, who had pretty decent track records managing money before they went to work for Buffett, but they were with much smaller amounts of money, so it's not an apples to apples comparison. And it's really hard to discern. Some of the old-time Buffett acolytes were really shocked when he brought them in. Anyway, leaving that aside, Zero Hedge put this out. I actually hand calculated it, spent like an hour doing it, but they put this out, which makes it a little easier to understand. So Wells Fargo was trading a little heavy this whole week. And it was because this professor, David Cass, had this article in Business Insider. Warren Buffett may have dumped his entire Wells Fargo stake last quarter, finance professor David Cass says. And they had it out there, and I was thinking, maybe. He dumped. The big thing for Warren Buffett is reputation. So obviously, Wells has had their reputational challenges, but that was over 2 years ago. So if he wants to say, I don't want to be associated with it, he should have dumped 100% of his stake 2 years ago when they got caught with the sales practices. They didn't. They defended them. They weren't completely happy with them. More bad news came out. They kept saying, Charlie was out there. Well, no one's perfect kind of thing. So that kind of reason to sell is not really you can't pull that 2 years later and say, well, I wasn't happy with, because they've also changed management, so now you have a clean slate. So that's not the reason. The big surprise of the after hours thing was that Berkshire sold 61.5% of their stake in JP Morgan, which has a pristine reputation and superlative management in Jamie Dimon. Like, he's kind of like the last guy in the world you want to bet against. So that was shocking and surprising that Berkshire sold 61.5%. And, you know, for a move that big, I have to assume that Warren was involved, which was surprising. And, you know, if you remember from his May 2nd annual meeting, he was spooked by the virus, and, you know, he's very good friends with Gates, and Gates was around saying, like, this is really bad. So, and obviously it is and was in many senses, but not the magnitude of what it looked like at that time. And if you look across his holdings here in this chart that Zero Hedge put out, it looks less like a I hate a particular sector or company, and more like a guy desperately trying to raise cash. And we covered after that annual meeting, you can look at our podcast VideoCast the week after May 2nd. So it would have been like, call it May 7th, 8th, or 9th. You can go to the website. And we put out the thesis that at that point, he made an allusion to unknowable insurance exposure. And I think that he was, and not relying on the kindness of friends, you know, with your hand out to ask for money when you need it. He's never wanted to put himself in that situation. He likes to be on the other side of that trade like he was during the great financial crisis, but he doesn't like to be there himself. So he sold 61% of JP Morgan, potentially because JP Morgan was also holding up at that time. That's number one. Jamie Dimon was also pretty pessimistic during that period, worried about loan losses and credit reserves and that type of thing. So, you know, they could have just been scared at the moment. He, on his other banks, he kept Bank of America. So it doesn't seem like it's a thesis, purely against banks, because he kept basically his position in Bank of New York Mellon. It was down 9%. So he took down Goldman Sachs. He took down 100%. That's basically an investment banking operation. He took down JP Morgan 61.5%. He left U.S. Bank Corp basically the same, which has very little investment banking business. He kept Bank of New York Mellon pretty much the same at negative 0.9%. So, and he took down Wells Fargo by 26%, which is big, but it's not nearly as big as Goldman Sachs and JP Morgan in percentage terms. He also took down, in a big way, he took down Sirius XM. Looks like, I didn't calculate the percentages because it's not a bank, but it looks like, give or take, 60-70%, give or take. And he took down Liberty Media quite a bit. He took that down, give or take, 40-45%. So he took down exposure across the board, like a guy who needed to raise cash or was worried for insurance exposure reasons because he couldn't quantify his COVID risk. But he did it particularly skewed in banks with big investment banking exposure, like JP Morgan and Goldman Sachs. Wells Fargo has a smaller investment bank, and Bank of America, he kept the same, and subsequently has increased a couple $1 billion in recent weeks, and maybe more. We don't know. And then he also bought back 5 or 6 billion shares of his own stock. So this was, initially the headlines were somewhat shocking, but given what the market, how it was trading this week on these headlines that he sold 100% of his Wells Fargo position, which, and some guy tweeted me, I was like, why don't you wait till the filings come out before you draw any conclusions? And sure enough, this was an exaggeration and a really reckless headline. But nonetheless, he did trim. So he took off a quarter of his position, and he took off a lot more of other positions. Now, the only thing I can say is you have to put in mind the context of where we were, just to give you an idea. The June quarter, this is filed August 14th, 40 some odd days after the end of the quarter. That means he was a seller between April 1st and the end of the quarter in June. So somewhere in this range, he was selling the lows in JP Morgan, more or less the lows, because it's already rebounded back up above this cluster here. And the same was true with Airlines, which he didn't sell 100 or 61% or 25% or 9%. He sold 100% of all of his airline holdings from this period, April and May period, at the lows, and they subsequently rallied as a group. This is Jets, the ETF. They rallied as a group 100% after he made the announcement on May 2nd. So this is May 2nd. He sold off all his airline stocks in this period after the crash, and then they rallied 100%. They came back, and now they're breaking out of this wedge. Again, it's hard to, Buffett was the man, the buck stops here. He went up on stage and told the story on May 2nd why he sold the banks at the lows. I'm sorry, some banks too, but the airlines at the lows. I'm not sure what impact, he obviously knows what kind of reserves he needs to have when he can't quantify the insurance risk, which no one could in March and April, and maybe to some extent he can't fully quantify today, although it looks like it's not going to be as bad as expected across the industry, and that's why they're all starting to move. By the way, for those of you listening to the podcast, go to hedgefundtips.com. You can fast forward to the 60-minute mark on the VideoCast to get the last bit. We've got to cover quite a bit on Warren Buffett here, so it came out after the bell. I didn't intend to cover it, but it's an important subject because we've been talking about it for so long. So again, he did discuss at the annual meeting that his belief was they were going to have to raise too much equity over time, the airlines, that is, that he just thought it was better to sell at the lows than get diluted over time. And that may prove to be true. In the short term, it's wrong. They rallied 100% after the announcement. They're now, they consolidated, and now it looks like they're moving up again. We don't, but we don't know. Warren Buffett doesn't think in terms of 6 months. He thinks in terms of 6 years or more, probably 60 years or more. So, the jury is still out on this one, but in the short term, they're moving higher. And what percentage of the decision was made by Warren Buffett versus what percentage of the decision were made by his less seasoned lieutenants who are successful in their own right, but have a different skill set that they came to Berkshire with. They were managing smaller companies, smaller cap stocks, more concentrated portfolios, smaller amounts of money. It is a different skill set. That's not to say it can't translate, because valuation is valuation, but been through less cycles. So how much of Buffett's decision, Buffett knew he had to raise cash to have insurance buffers, but how much credit is attributable to him for selling the banks and the airlines at these lows versus his lieutenants who are doing most of the trading and investing these days? It's hard to tell. I don't have a good answer for that, but all I can do is worry about what I do and take serious people seriously. And, this is something that we're discussing because of that reason. But if you look at the long term, this is Wells Fargo, for instance. You're basically getting it at 12-year-old prices. There aren't many instances in its history where you can buy it at a 50% discount for very long. You had one opportunity in the great financial crisis, You had another opportunity in the recession of the early 90s. You got 30% drawdown in 2000, 2001, but not a real opportunity to buy it cheap. So basically, you've had two opportunities in the last 30, 40 years to buy it at this discount to book. And even during the great financial crisis, when there was no liquidity because the government didn't act quickly, it fell more than 50%, but it recovered equally as quick. It was back at new highs in about a little over a year. So, and that was a much different scenario, a much worse scenario from a credit standpoint than what we have today. So I look at this, and the other thing, it's funny, there was a picture on Twitter of Warren Buffett sitting at his desk with the Value Line binder. For those of you who are a little older, Value Line used to come in these binders, and you get all these paper things, and it's for value investors. You look at stocks, they have tear sheets, they show the data. And this guy, Brandon Van Z on Twitter says, let's see, curious if Warren Buffett went to work on more than just the Value Line binder looks pretty beat up, so there's hope. So that's a Value Line binder sitting right behind Warren Buffett. And it's interesting that there's a Value Line binder because we are going to pull up the Value Line on Wells Fargo. I hope he's allowing his lieutenants, Todd and Ted, to use this binder and not just keep it in his own office, because what we're going to look at here is Wells Fargo over the years. If you remember, in 2009, it had that crash. Its book value per share was about $19.94. It traded down to $5, and then it traded right back up to book. Actually, premium of book, it traded back up to $25 within a year. So it traded back up to a 20% premium over book in a year. So let me just pull this up. Oh, I'm sorry, here it is. Okay, so what you can see, the reason I brought this up, number one, is I love that picture of the binder, but number two, sometimes you just have to look at the simple fundamentals and leave the emotions out of it. Yeah, we all know there are going to be defaults. We all know there are going to be credit losses, just as there were in the great financial crisis and as there were real estate in the 90-91 period, both the last two times you were able to buy Wells Fargo at this big of a discount to book. So it traded down below book, and then it rebounded to a premium. But if you look here through history, even through the great financial crisis, which is a black of all black swans, book value per share has continued, as Buffett would relate to it as it relates to Berkshire as intrinsic value per share. It's continued to grow even through crisis. Yeah, earnings vacillate tremendously around it. In 2009, earnings dropped to 20 cents. I'm sorry. Where's earnings per share? So earnings dropped to 70 cents. This year they're dropping down, and then they rebound. But book value consistently grows over time, and this year it's about just under $40. Next year it's expected to be $41.25. But what I want to point out, because large banks trade, money center banks trade at a discount and premium to book over time. And historically, if they're good franchises and you buy them at a discount to book, you make money over time. So if you look at 2009, the book value was about $20 per share. It traded down as low as $7.80. So a greater than 50% discount, 60% discount to book, and as high as 31.5, which would have been a 50% premium to book. In 2010, the book value was $22. It traded down to 23, so just over book, and as high as 34, so almost double book. Not almost double book, but 80% premium to book. 2011, the book value was $24. It traded between 22 and 34, so give or take a 50% premium to book. 2012, book value was 27. It traded up to $36 and down to 27. So from book to almost 40% premium to book, and it just goes on. And you can see this range, but it's very infrequent that it trades at a discount. 2013, it traded $30 book. It traded between 34 and 45. 2014, $31 book. It traded between 44 and 55. 2015, $33 book. It traded between 47 and 58. So almost 2 times book. Same thing in 2017, $37 book. It traded between 49 and 62. 2018, 37 book, trade between 43 and 66. So at these levels, you're looking at almost 2 times book. If the book's going to be $41 next year, and it's 38, 39 this year, so let's call it $40 round numbers. You get close to 2 times book. That's $80 a share. Cut that in half, a more realistic high end of the range during those periods in the cycle that it trades at a high end. That's a 50% premium to book. You're looking at $60. So trading back to book of $40 is not unreasonable, and yet no one sees it as a possibility right now, which is the opportunity. Now, you could say, no. This time it's different. This is the age of fintech. Square and PayPal and all these companies are eating into it, and that's the end of the end for Wells Fargo and Bank of America and JP Morgan and all the banks with and Rocket Mortgage is going to take all their mortgage business and everything else. 2 things. Number one, they're using the pandemic as an opportunity to cut $10 billion of expenses and to close a lot of branches. Their digital investment, if you listen to Mike Mayo, across the board is through the roof. So if you think they're going to just sit back and get destroyed by these small players that are commodities, I think you might want to think twice. These companies have been around for many, many decades and gone through many, many iterations. So I would say there's a lot of fat to cut out, which is going to drop to the bottom line, number one. Number two, they are massively investing in technology, and they'll just be able to undercut on price in the short term, regain share, and there's plenty of room because it's growing for everyone. Digital money is going crazy. And then you've got 85 million baby boomers that are now accelerating their housing formation. Mortgage business is out of control. They're one of the largest lenders in the country. So don't count them out. And Wells Fargo and Value Line has it right. They have price projections between $45 to $70. Those are not really worth much, but it's worth looking at. And they did the same thing now that they did in 2009. They cut the dividend, and then the stock just rallied. So the stock was trading heavy on these silly headlines from Business Insider that Buffett had sold 100% of his stake. He sold 100% of Goldman Sachs, which was a tiny position. He sold 60% of JP Morgan, which is a big surprise. And he sold 25% of Wells. So leaving that aside, whether it was Warren or Todd or Ted, I think that you got to do your own work and make your own decisions. Airlines, I'm not in love with equity on the airlines. I think there's opportunity in the debt, but there might also be some selective opportunity in the highest quality airlines for the long term. But selling down here, the time to buy insurance is when it's sunny, not after the storm has passed. And it's the same thing with these banks, unless they're, so that's that. The other thing is for the technical people, and I don't spend a lot of time on this, but there's, if you look at this long-term chart, there's a lot of, this is basically the breakout back test of all breakout back tests. So you had all of this resistance at around $25 from 2007 to 2012. It kept bumping up against $25 and it couldn't get through. Bumping up, couldn't get through, bumping up, couldn't get through, bumping up, couldn't get through. Finally broke out, rallied to $58, and now it's back to what was resistance is now support. So obviously you want to see it hold these levels between $24, $25, build a base, and then take back off, which is what a breakout backtest is. The only other time it did this breakout backtest business was, it did it here in 1997. So you basically had this breakout, and then you back tested and then you rallied for years. And then also in that other recession, which was it broke out in 1988, back tested it in 1990. Remember what was resistance? Resistance became support, and then rallied for basically 2 decades until the great financial crisis. So here we are, the mother of all breakout back tests to 25, and holding there, and it could be a potentially secular type of long rally setup as that huge millennial demographic is in their peak housing formation, and that's, you can trace that back throughout history. So just thought I'd bring up a couple longer term perspectives. Here's a short term perspective, by the way. So this week in our client accounts, we had a bunch of Berkshire Hathaway January calls that were up 300 and just about 350%. We actually sold 20% of those because of the excessive exposure to Apple. If we want Apple, we'll buy the NASDAQ, which we don't want to be overweight Apple right here in the short term. And we actually put those profits from we're holding 80% of the January Berkshire. I think it's going to consolidate here, but and we put all of that into Wells Fargo in the last couple of days down here as it went back down because of the silly headline. So thank you to Business Insider for putting out that ridiculous headline. And we loaded up and increased our option position on Wells by about 50% on this weakness this week from the Berkshire profits. So we're basically fading Apple on that and buying this value in addition to the stock that we have, but with leverage because we think there's a huge opportunity here. Now, why do I have the 60-minute chart up here for Wells Fargo? Because it just shows you where price is consolidating. So these bars on the left are volume by price. That's where all the majority of the stock has been bought in this range. And once you can break through that, so all these people who were negative and now they get to positive, they want to dump out of it because they're so scared. Same thing here. They want to dump. Once you break through that and the vast majority of these short-term holders are profitable, the next resistance, if and I don't use this a lot, but when, fundamentals, when you've done all your fundamental work and you're looking for additional edges, so to speak, the next point of resistance is not till you get up over book value at $46. And I think that's where we go. And I don't know if it takes 3 months or 6 months or 18 months, but I think to trade back up to book or a little premium is very reasonable, and at a 50% premium to book is in the cards. That might be years, but I think this is a huge, huge, huge opportunity, and we'll probably exercise a bunch of those options as well as take profits on them as they do what Berkshire did. I mean, you look at this huge move in Berkshire, which we bought in June. I mean, this is just completely off the charts, and we think Berkshire is going to make new highs. So if we get further weakness, we'll probably reload on those. But when you're up 350%, you take profits and then you reinvest on in other opportunities and you ride the rest. So I wanted to spend a lot of time on this because the news headlines are going to be hot and heavy on this subject. Let me make sure that we've got everything related to this subject before we wrap it up and move on to the final points. So as Berkshire's had that monster move with the heavyweight in Apple. Here's the other thing. This rate thesis that we've been putting out for 4 or 8 weeks has gotten even better. The 210 spread, the net interest margin, possibilities going forward, the demand for loans, everything's gotten better. Remember the last 2 times this happened where the 210 spread widened. Again, it's not where are rates, it's what's the spread between their cost of capital and what they pay for capital, the short end of the curve, and what they charge for capital, the long end of the curve. When that spread widens, that's called net interest margin. That has a huge impact on banks, particularly those banks that lend, and that's probably why Buffett and company dumped. Goldman doesn't have a lending business, a material lending business, a mortgage business. JP Morgan does, but it's not the size, JP Morgan Chase, it's not the size of Wells Fargo or Bank of America. So he's betting on Bank of America with that thesis. Wells Fargo is almost as big. And I believe that asset cap can get lifted, which will even accelerate the process and possibly be a huge catalyst right back to book. We'll see if that plays out or not. But has this gotten better or worse since we laid it out a month ago? Much better. So this has continued, like you see here in 2009, the spread has continued to widen, and same thing with 2003. So here we are, and sure enough, financials are rallying because of it, just as they did the last time that spreads compressed and then they expanded, spreads compressed, now they're expanding, spreads compressed, and then they expand. So this is a good thing. The thesis has gotten better, and that is it for Berkshire and banks and what we're doing about the news. Okay, now we're on to sector earnings. We do sectors each week. This was the aerospace and defense, which we love. In the last 60 days, the 2021 earnings have come down by 3.2%, which is not bad. Those will turn up materially as we continue to come out of this cycle and people see Q3 GDP and confidence comes back and we get closer to the vaccine. Again, that's the whole cyclical story. So that's a good thing. Utilities, cumulative earnings power came down by 1% in the last 60 days. So those are holding up pretty well. Energy sector, XLE, top 30 weights, was revised. 2021 earnings were revised up by 26% in the past 60 days for energy. That thesis continues to play out. I think that's another pocket of opportunity besides financials and defense. And this was real estate earnings have come down for 2020 have come down 0.5%. These are basically flat. So that's interesting to see. Those will probably come down a little bit though with all the REITs. So finally, economic data. Let's take a look here. A lot of good things, again, beating, let's see, Michigan consumer sentiment beat this morning was 72.8 versus 72 estimates versus 72.5 last time. That's a good thing. Manufacturing production went up. Industrial production was flat. Capacity utilization rate, this is a big one. We're at 70.6, up from 68.5. That is good news. Unit labor costs are going up. That's to be expected. That's a good thing in the short term. And productivity was up from plus 1.5% estimates to, it went up 7.3%. That's huge. Core retail sales were better than expected. Weighted in electronic products, Zero Hedge put out a chart. I put it on our reads of the day. So, interestingly enough, companies that are getting smashed like Western Digital and Intel, with looking at the consumer spending in electronics, which is probably all the work from home and school from home computers, and they sell the commodities parts that go into those, I think those might potentially be an opportunity if you wanted to be in tech. Rather than chasing the things that are up 100%, you may want to take a look at some of those with a 6 to 9 month view. Again, opinion, click on terms. This is just my opinion. I don't know your situation. Check with your financial advisor. I'm just giving you my outlook. Initial jobless claims, we went over this, came down. That's a huge beat. Continuing claims came down. Those are the most important numbers of the week. Again, a huge draw in crude inventories. They were expecting a draw of 2.8 million barrels. It was actually 4.5 million barrels. Go back to the Rystad chart that I put out 4 weeks ago. I said this would be happening from surplus to deficit. We've been deficit ever since. Price continues to go up, and I think we're going to just wake up to a surprise. I don't know if it's 3 months or 6 months or 9 months down the road, but oil will be back at $60 to $70 a barrel because we've had no major investment in 5 years. Demand is going to recover. Yes, OPEC can unwind their long-term cuts, but it's probably not going to be enough to offset, and we'll see $60, $70. So there's an opportunity there. and go up high up the food chain, because there'll still be a lot of bankruptcies for the marginal frackers in the meantime. What else did we see? So that's basically it. The economic surprise index, here's from Yardeni. Again, it's still staying up here at off the charts highs, greater, almost double coming out, more than double coming out of the financial crisis. Here at 253, the amount of economic data that beats consensus view, off the charts. So on that good and positive note, I'm wishing everyone a great weekend. Hope you found that valuable from the election standpoint, from the banks and cyclical standpoint, and what Buffett did and didn't do. By the way, it was funny, as I was looking up Buffett's holdings, Stanley Druckenmiller, a legendary hedge fund manager for many decades, worked under Soros, then did his own magic, became a multi-billionaire. He was buying Wells Fargo this quarter, so what do you know? Leaving that aside, you know what my analysis is, at least the vast majority of it, and how we're thinking about it. And we'll see how it plays out, not over the next 6 minutes, not over the next 6 days, but I think 6 months is a reasonable time frame. And we'll see you on the other side. So make it a great week. Thanks for listening in, and have a great one. Bye-bye.